Greetings, everyone. Thank you for joining us today. Today's module will focus on the advice of program directors towards new trainees. And our target audience here could be interns, residents, fellows, or even junior faculty. In medicine, we often don't get training in personal finance and principles of financial literacy. And with this series, we're hoping to correct some of that. A couple of housekeeping issues. Number one, none of us who are here on this recording are experts in anything except medical education, I guess, but all of us have a fair amount of experience in working with trainees. And so for the purposes of a disclaimer, this is an educational session for formal advice. I suggest you seek out professionals to help you navigate your personal finance decisions. So today's session will focus on advice from program directors for trainees regarding financial issues. And I am thrilled to have two of our former chief residents here at Brown, Dr. Ross Hilliard and Dr. Patricia Eng. I'm going to let them go through their introductions themselves. They can tell you a little bit about what they do now and what led them to be on this recording. We're also joined by one of our current Brown Internal Medicine chief residents, Dr. Bridget Harrop, and she's going to ask some of the questions that may not come up to me. My name is Dominic Tamaro. I'm the Vice Chair for Education here at Brown. A couple of years ago, I sat in on a workshop that Patty and Ross led at the National ACP meeting. And they were addressing a group of resident ACP members, the American College of Physicians. And the topic was personal finance. And the wisdom and judgment with which they addressed the audience and answered questions was one of the items that really had an impact on me and gave me the idea that this could be expanded and made available more widely. So I encourage you to listen to their wisdom, and I think for the beginning, maybe I'll ask each of you to tell a little bit more about yourselves, and then we'll get started. So Patty, why don't we start with you?
Sure. Yeah. Hi, guys. Thanks for joining us. So I'm Patty Eng. I'm the program director at Stony Brook University on Long Island, New York. And my interests for financial literacy and wellness actually started as a junior faculty member starting here. I came in, like many new faculty members, not having a lot of knowledge. And basically, a colleague of mine had gone to a workshop at one of our MedEd conferences, and they were doing financial literacy education at their institution. And we thought, hey, can we build that at Stony Brook in itself? So actually, in collaboration with our retirement planners at Stony Brook, I learned a lot from them, learned a lot myself, and based off of the lessons learned that they see with faculty joining in, I try to instill that knowledge into our trainees, and we've been able to continue that financial education for our residents, and definitely excited to share some many mistakes that I've made myself, and how you can have a better financial plan for yourself moving forward.
And I'll just point out that in preparing for these sessions, myself and a couple of other colleagues did a literature search. And Patty is really one of the few GME faculty who have published on financial literacy education. We'll have a link to the most recent article that she's published, I think in the Green Journal.
It was JGME, I think, both, yeah. Mm-hmm.
Okay, but we'll have a link to that article as one of the resources for this topic. So thank you for joining us, Patty. And Ross?
Hi, everybody. Nice to be with you. I am the program director at Maine Health Maine Medical Center in Portland, Maine, and am absolutely not an expert. I think I come to this mostly in being a fan of Patty's, and us over time chatting and talking about this, and bring my own kind of experience, both positives and mistakes, as we think and talk about this. But I've also attempted, again, copying Patty, to incorporate some of this within my residency.
Thank you, Ross. And Bridget, how about you?
Hi, everyone. My name is Bridget Harrop. I am a former Brown Internal Medicine resident, current Brown Internal Medicine chief resident, and future Brown Internal Medicine HEMONC fellow. And I am very excited to learn from everyone else here today.
So thanks again for joining us, all three of you. So let's start out with the scenario. A new intern comes in. It's maybe not quite July, maybe it's August. And they come into your office and they have some financial concerns. They're not sure kind of where to start with this new paycheck that they're getting. Really, it's the largest regular paycheck that they've ever gotten before. And they're trying to make the right financial decisions. And because they trust you, they come to the program director's office as part of their initial getting to know you meeting, and they ask you for your advice. So let's start with that scenario, and we'll take it from there. So either of you could start.
For I think anyone with a new paycheck and think about their plan, I think building their budget is incredibly important. There are some suggestions, like in the literature, of particular percentages where maybe 50% should be your essentials. That would be, how much does it cost for you to pay your rent, to get your groceries, to pay for any utility bills or anything like that, your car loans, whatever. And then maybe 30% would be your wants. So maybe long-term planning, like, hey, I want to plan out this vacation, this would be nice, going to a concert, I really want a new iPad. And then 20% should be about savings. And those savings could be more of your emergency plan, where if for some reason you didn't have a steady income coming in, could you cover those essentials? And just like for some unexpected, like, oh, I have like new medical bills I didn't expect, but that will be due. But also that 20% try to put towards some sort of more long-term planning of like a retirement. And I think one thing that I wish I had looked into more early on was, one, what retirement plans are at my institution already that I can participate in. Like here at Stony Brook, our residents are state employees. They can participate in the state retirement plans and actually get matching right up front as residents if they decide to do that. So your institutions might have that in itself. But then also unique retirement plans like, Roth IRAs, where you're in a lower income, bracket, you can participate. And then once you get into your attending kind of salary, you might not qualify for that. So I think that us starting off with a strong budget and sticking to it, that's, I think, a first great step. But I'll pass it to Ross if he wants to add more.
Yeah, I think I totally agree. And as someone who started off residency, I'm pretty sure with like $4 to my name, I struck that perfectly in terms of what was, using up my loans, et cetera. Having a plan and having a plan early on is really important. I think you can't overemphasize the importance of that savings plan early. It feels really hard as a brand new resident, and you've waited and gone through school and everything else like that. But the fact is, in truth, though physicians, we are lucky to have very high earning potential, we start that late, and so we all started with those earnings later than so many of our colleagues, and with that means we're behind in almost all cases. Physicians start out behind, and that's really hard to catch up with in terms of the longevity of savings plans, retirement plans that you can get otherwise. So finding a way to figure out a way to actually contribute to those long-term goals is really important. I think the other piece that is critically important, though certainly the landscape related to student loans and student loan forgiveness are a moving target. If there's any chance that you have the potential to be future, loan forgiveness folks, don't waste really even a single month of time doing some sort of an income-based repayment on your loans while you're a resident. That is that losing those months of time can be huge financial implications going forward. And so, certainly one of the mistakes I made was holding off, and I think I held off for about a year, but that meant a different year of a very, very significantly higher payment once I was a faculty member before reaching loan forgiveness. So that's definitely something to think about. And if you're having questions about that, seeking out some advice, because certainly we know that those things are changing. We hope that some things will kind of return more to where they were a couple of years ago in a couple of years. But definitely, should try to maximize your contributions while you're still making a resident or otherwise trainee salary.
Absolutely. I made the same mistake as Ross, actually. I missed out on a year, and that was a big hit for an extra year of attending salary for good days. Yeah.
Okay. Patty, you mentioned in one of your comments, you mentioned the importance of an emergency fund. What kind of emergencies are you thinking about?
Yeah, so I guess I'm thinking about, maybe, God forbid, you get injured and you're not working for a brief period of time, and maybe you're not getting a steady income like during that period, but you still have bills for paying your housing, food, all those types of essentials. Sometimes it could be an unexpected, maybe car repair too. Got a flat tire, got to buy new tires. I want to make sure that I can get that so I can, transport myself back and forth. And to, get an idea of just like, how much should be in an emergency fund. Starting off, I know it could be tough to think about like, should this be a year amount of money and that kind of thing. Even starting off for like 2 to 3 months is a good cushion. But I guess if you can expand it to more like 6 months, that'll give you even more cushion. But start small. But those are the type of emergencies. And sometimes you're thinking like, wow, it could take a long time to build that emergency fund once I add it up. Also remember there are different types of savings accounts that have higher interest rates. And so it can build on your money even faster. So like high yield savings accounts. There's also even more long-term certificate of deposit or CDs. The only challenge with CDs is that the rules of those, like you put your money in to grow for an X amount of time, but if that time frame is long, it could be even 2 to 3 years, you're not going to be able to get that money quickly. So CDs could be better for more like medium type of goals, but you definitely have access to high yield savings accounts, which right now, actually a lot of them could be, 4% or higher, where sometimes the traditional savings account, like I think I started off with Bank of America, it's like 0.05 or something, definitely less than 1% with growth. So you could take advantage of that to help grow that emergency fund. Mm-hmm.
I was going to ask Ross. So Ross, my car needs a new battery, a couple $100. I can just put that on my credit card, right? Is there a problem with that?
That is certainly something you could do, but the credit card trap is one, in truth, that I got myself into and then had to get myself out of in residency and immediately thereafter. And so it seems like free easy money, but there is no free easy money. And so, certainly, if you have an emergency and you don't have that emergency fund, or it exceeds that emergency fund, then it is a method of liquidity to kind of go relatively quickly. But it comes with a significant price tag, and it's really easy to get behind the 8 ball there. And you end up really just throwing away money in the interest that grows.
I agree. I think the most important first step, besides a plan and a budget, is getting that emergency fund cushion ready for the unexpected car repair or what have you.
That said, there is a place for credit cards. There's a place for building your credit history as you go forward. So, responsible use of a credit card is actually probably beneficial and is something you should practice. But my strong advice would be to work very quickly to be in a place where your budget and your plan is to pay that card off every single month, which means you can get the benefits of having the credit history, of having the good credit history, without the incredible amounts of interest debt.
Bridget, any questions so far?
I was just wondering, when residents are starting out and thinking about building this emergency fund, knowing that emergencies are so hard to foresee, like something where it's like a car repayment could be a couple $100, it could be a few thousand. Do you recommend targeting a specific number, a specific percentage, or is that kind of individualized to each resident?
I'd start with what Patty said and trying to aim for that like 3 months of salary as what you have, right? And certainly you want that to be more as you go forward. And Patty mentioned illness, injury. Another element to think about related to all of this is protecting yourself with disability insurance. In virtually all cases, what comes from your employer is nice, but not sufficient. Most of those are like 60 or 70% of your income, and particularly if you, as the trainee, are providing the significant income for you, your family, etc., that's not going to be enough to fly with. Most people can't cinch their budgets that much to be able to go down. So having and thinking about some of those other ones are there. I guess since I jumped to that topic, they come out of the woodwork at you, particularly as a trainee, and that was always strange to me. But
Ross, clarify. They
I apologize. Oh yeah, the disability insurance people, the people who sell disability insurance, both the companies directly as well as the brokers who work to connect to those. And that was overwhelming to me and seemed kind of confusing to me. But the way that works, particularly for physicians, is that you have better rates if you start in a plan before you leave residency. And this could be really hard because I think in some cases there are situations where it's almost predatory, kind of a predatory, not predatory loans, but predatory financial folks. And so what I ended up doing, and this is potentially good or potentially bad, I don't know, is really going through one of the professional organizations. So I actually went through ACP, trusting that they, as part of their group rates, but that someone smart at ACP had done their homework related to what was going on, and that was far easier than the people who showed up and tried to sell me or email me or call me or whatever else.
If your institutions does have someone to talk to you about disability insurance, I think, as Ross had said, take it with a grain of salt, do your homework, compare quotes, understand what the fees are, what the policies are, and ultimately don't feel pressure to just, buy it for them and thinking like, oh, is this the only company that's out there? There's so many different ones. So just, compare them and make sure it's right for you.
And physicians have, I think Ross's point about getting your own private and therefore portable insurance for disability is important. Physicians, as a profession, tend to use disability insurance at a higher rate than the general population, and so the premiums can go up steadily as people's incomes go up. So getting in early is I think really great advice. And I look at insurance as you're paying a company to share a risk. So the risk of not being able to work, if you don't have insurance, well, you're going to shoulder that entire risk. Whereas if you have some disability insurance, then the risk of becoming disabled and unable to work is then shared. You'll probably support some, but you're paying a company to share that risk and support. I think that's an important topic, and I think that was a very smart thing. I think going through ACP, because did they have the best deals? Well, I don't know, but certainly they've done a lot of the homework that Patty is suggesting we all do. Certainly your HR office, your GME office at the place that you're training are other potential sources to get references for disability insurance brokers.
The other piece of insurance to think about while you're a trainee, and thus in most cases in general, younger and healthier than you will ever be, definitely younger than you'll ever be, is to think about life insurance. I think, for most residents, the life insurance that's provided by your employer is probably sufficient, and the risk that you're going to need it during residency is hopefully very, 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 very low. But there is a sweet spot somewhere in the time around being, a recent graduate and an early faculty member where the calculus changes, and where you and the people who rely on you will need to have more of that kind of backup. Again, things we hope never happen, but in our jobs we know that it does. And getting in on that earlier lets you get significantly better rates, right? Like if you can get your life insurance when you're still in your 30s and before you have multiple diagnosed conditions, you're going to do a whole lot better in terms of rates than if you wait until you're in your 40s and have a couple of things and are on a couple of meds and other things like that.
So many programs offer help with retirement saving. And as a trainee, I might be thinking, just as I think, I forget if it was Ross or Patty who said, oh my goodness, retirement. I just started my career. How can I think 40 years ahead? Tell me a little bit about your take on retirement saving, where it falls on the whole spectrum.
Yeah, I mean, I guess, prioritizing, if we did put in a number, I feel like emergency fund comes first and then like the pieces for retirement saving, but it's that compound interest. If you start putting in now, it's going to only grow over those years. And I think part of the prioritizing too is like, even if it's a small amount of savings of maybe it's $50 a month or something like that, it will grow. And I think it's a great opportunity if your institutions do have retirement planners to chat with you, just to start learning early. Like, set up those meetings, get an understanding from them of just if we really wanted to optimize what's a reasonable amount. You can bring in like your budget and share it with them, and they can kind of like walk you through what would make sense. But yeah, definitely it can feel quite daunting of trying to put your money in different types of buckets, but it could be surprising, what $50 is, could be one fancy dinner a month or something like that. And be like, this is investing in my fancy dinner once I like in retirement or something. You can think of it that way. Yeah.
I think spot on. I think the only things I would add would be, as a trainee, trying really hard not to leave free money on the table. So if you have an employer that has a match at all, contribute enough so that you're taking full advantage of that match, because that is free money from someone else that goes in and again goes towards your compound interest and growth over time. I think the other piece I would say there, and Patty may disagree, but I think as soon as you are making your attending salary, there's a lot of things to try and avoid shifting. But I think the first thing that everybody should do is at least maximize your yearly contribution, like right off the bat. Take that, and if anything else, that's just like, okay, I'm going to pretend my salary is a little bit less, but definitely start to do that. Again, like we said, physicians start late. We certainly have high earning potential, but we start late, so you start behind the 8 ball in terms of that long-term return.
I agree with Ross about trying to maximize as much as possible, and definitely if it's also pre-tax money going in, that's only going to help also in your taxes too, with that calculation. Yeah. Mm-hmm.
I think what I was going to say is that, it's really simple math. Maybe it's not simple, it's the wrong word, but the idea of $10 put in a retirement account as an intern will work much harder and grow to a really remarkably greater degree over, say, 40 years than the same $10 put in 10 years later will only have 30 years. That 10 years of head start makes a huge difference with respect to the growth and preparation for retirement. If we rewind and go right back to the beginning, I think Patty mentioned the importance of the budget and with the 50-25-25 rule. Could you comment on, I'm going to say, and I'm sure no one's going to disagree with me, but comment on the importance of living within your means?
I think that is definitely essential. So with the budget, be strict about it. But we do understand that, right? We want to be able to enjoy it, but I think like really map it out and plan it out. Like have whatever, if it's an Excel sheet, there are definitely a lot of apps out there that can automate. You just have to plug in the numbers and kind of like map it out towards you to say like, hey, if I'm going to pay this in full and not be always in the negative, for a few months, this is how much I have to put away for it. But I think even when you become an attending, if you can be able to live like a resident for a few more years so that, the rest of it's going into your savings and retirements and that kind of thing, that's going to go a long way. There's definitely a lot of resources out there that say live as long as you can as a resident for those savings. And I think it'll really help in the outcome. Yeah.
Yeah. And I guess I just emphasize, and from my own experience, like that's hard, right? Like it's really hard. And you're going to see people who are doing other things or doing fun things and, other stuff like that. And it will seem like everybody else has it together. They probably don't. And they may be making some really foolish decisions, but that can be a big challenge. I think just like Patty said, in terms of the apps, I think there are definitely, tools out there if you're not the best budgeter to at least be able to keep an eye on your money and really understand where it's going, rather than just like opening up your app and saying, oh, there's money in the account, so I guess I can go and do stuff. It's in some way, form or another, getting a closer idea so that you're at least conscious of what's coming in and what's going out.
Yeah, many of the apps are very elegant in their simplicity. The responsibility relies on the user to stick with it. Ross, would you comment on strategies for saving? And if you could read my mind, what I'm thinking of is, do I make a decision every month to save $50, or do I try to automate it?
Automate it all the way. In truth, like, especially as a resident, like automate as much of this as you can, both in terms of savings and in paying your bills, right? Like if you've got that credit card that you do use, but then pay off every month because, you're using it at the gas pump and you're getting some cashback rewards or whatever else is there for a card and building on that credit, like set up your banking app to both pull in that bill and then pay it automatically. Set up your banking app to pay your rent automatically, right? Like your rent, your mortgage, whatever you're doing, have all of that go and just be set it and forget it. Figure out the cadence at which your paycheck gets deposited and have an automated next day transfer to your savings or whatever else, just so that it's there. And a lot of talking about apps, a lot of banking apps now will have you be able to like look at all of those and see all of those, as well as the kind of future transactions that are planned, just so you can make sure that things are on track. But the more you can do that, the better. I absolutely, I had colleagues in residency who, had forgotten the light bill for a couple of months because you were in the ICU and then you were on nights and you were something else like that. And right, like, oh crap, now I have fees and other stuff like that. So the more you can set up to be automatic, it's just easier for you. And, spoiler alert, you get to be an attending. That doesn't mean that you magically have all these times to, all this time to sit down and manage your bills. So just set it up to just go.
Yeah, and I think that's important. You don't miss what you don't see. So if the money automatically goes into your savings account, after a few months, you look at your savings account, you say, oh, I didn't realize that I had saved that much. And it's really remarkable, but it also kind of forces you to live within the scope of what you actually can see and not that which is automatically removed from your income, which is a sneaky but really helpful way to simplify your life.
You can even, I haven't done this, but you can, maybe Patty, as usual, Patty is way smarter than I, so she may do this already. Like, you can actually set up with your direct deposit. You can set up, in most cases, a percentage to your checking account and a percentage to another account. So you could even go further upstream and have your work and your paycheck just start that savings plan for you.
I don't do that. So, but yes, that would be incredibly smart.
Bridget, any questions that I haven't asked that should be asked?
To go back a little bit, I know Patty was talking about retirement. I know a question that myself and my friends have had throughout residency, which I felt like we were never sure about a clear-cut answer on, is with there being variability in residencies matching a 401k or 403b, if you're at a program that does not do that, is there any wisdom on still doing the 401k or 403b or moving more towards a Roth IRA? I feel like I've heard people say both things.
So I think it really depends on kind of maybe what mutual funds or stock options you have, and also is it portable with you? If it's something where, but usually which it is, or you just like can roll it into the new institution and that kind of thing. And then I guess with the account, it would depend on maybe they can have the Roth IRA there with you too. So I think it just depends on maybe the fees, what stock options that are available to you, and then also if there's any other services that you would like. Maybe you don't have to pay an extra fee to have one-on-one meetings with a financial planner there. If already institution's paying for that, great. Whereas if you did your own personal account, maybe there is like an extra percentage fee out of that. But I think I would just like make sure the nuances of like, oh, if I don't stay here at the institution, how does this follow me to the next place after I invested this, money in there? Mm-hmm.
Though all of those should always move, like that's required. It's not going to get, it won't get kept by there. You can leave it there, but you can also roll it over in virtually all cases.
And I'll just add that if you go to some place that doesn't offer a retirement plan as a trainee, you can always open your own, right? And so we talked a little bit about a Roth plan. I'll just jump in. The difference between a traditional and a Roth IRA, for example, is the traditional IRA, the money is put in before taxes, and you pay taxes on that money when it comes out, when you're retirement. A Roth IRA, the money goes in after taxes have already been taken out. And so as a young earner who's going to earn less now than you will, say, in 10 years, those are often the more desired flavor of IRA. But you could call up a discount brokerage like Fidelity or Schwab and open up your own Roth IRA right now. You just have to earn a certain amount. And that's your business. That's like your own bank account. So that's another thing to think about.
In most cases, as soon as you graduate from training, you're going to exceed the limits for a Roth. But having been in the same institution, Bridget, with you, and they didn't have a matching, I put my small retirement amount that I was able to do into a Roth while I was a resident. The one thing I would bring up is there is a sweet spot at some point in training or immediately thereafter where I would argue getting a tax person is absolutely worth it, right? And this was a lesson that took me a little while to learn. I had done my own taxes when I was, doing student work and, summer jobs or whatever else, making not much money at all. And, like the one tiny little research internship that I think I got paid $20 for while I was a medical student, that's an easy 1040 that you can fill out on your own. The benefits aren't just that it's something that, in truth is not worth your time overall. The benefits are also there in terms of understanding how fast the tax code is changing, as well as, and this was what I didn't really realize until I'd gone and found a tax person, the kind of peace of mind of if something comes back, you've got somebody who's going to be there with you with the IRS as compared to doing it yourself. If you get audited, if something else comes along those lines. So I think, in most cases, especially early on, your taxes aren't going to be so complicated that it's going to cost you a lot of money, but the peace of mind and the confidence that it's accurate, as well as the saved time for you, is really worth considering.
I think that's very wise. Ross, do you have any experience with online or software-based tax prep options?
Absolutely. I won't. I don't want to endorse a single thing, but when I was early in residency, I still did like the online H&R Block free file. You in residency, in most cases, will still be able to have an income low enough that is eligible for those things. Most attendings aren't. eligible for the free files, and your taxes, as well as you do the more of these retirement things, or you have a mortgage, etc., they get a lot more complicated a lot quicker. And unless you just really enjoy going through the nitty-gritty nuances of all of the different forms and other things like that, let a pro do it for you.
Yeah, I would agree. The other thing is that you have someone who's there, as you pointed out, in case you get audited, but you also have someone there who can help you do some planning. I know this is what we're doing this year, but if I do this year, how is that going to affect my taxes next year? That's a question that you can't really ask unless you have someone familiar with A, the taxes, the tax code, and B, your situation.
I definitely echo what Ross said about getting an accountant, a tax person, and as everybody said, they'll help give you guidance like each year, and also they're a go-to person even throughout the year to help plan things out if your life situation changes, or didn't expect to buy this house but now you did, so how would that impact your budget and all that kind of stuff. Yeah,
I think the only other piece, just from my own experience, was if you're making big purchases or anything like that before you move, think about and understand the implications, right? Like, I started off residency, I had I was moving from the south to the north. I didn't have an all-wheel drive car, went to go buy an all-wheel drive car in a state without significant sales taxes on cars, very low, and moved to Rhode Island a couple of months later, where there's a significantly higher sales tax. And actually, when I registered my car, I got hit with like a $2,000 tax bill. And that was certainly not pleasant at the moment, because I hadn't yet started making money. And so there are things like that you should consider if you're doing big purchases, especially right around graduation or something like that.
Can I ask you both if you have any advice on where to get advice?
For just maybe like free resources, now that ACP is doing a lot of webinars about financial planning and that kind of thing, definitely join in there. Also the AAMC, which gives a lot of advising for students, residents, fellows. They have a whole financial planning section as well, and they also have a whole asynchronous modules where they go through like each big kind of financial planning bucket and kind of go through. And then this is, I guess, a blog, but White Coat Investor, I forgot the name of the physician, but he's a emergency medicine physician, and he does talk about a lot of things that we talk about today, and in addition to advanced sort of topics. I think that has a lot of helpful information as well. So I'd say those are three, I guess, like more free resources available.
Mm-hmm.
I would encourage people to stick with those. I think if you're going beyond that to, financial advisors or such that aren't part of what's provided through your employer or other things like that, the big caution is to make sure that you're working with people who are in a fiduciary role with you, and making it very clear that you're entering in a fiduciary role, which they have legal requirements related to giving you the best advice for you, rather than other things. Because there definitely are people out there that will try to give you advice, but if they don't clearly have that established role with you, I would be concerned.
And the reason for that concern is that many of the people who offer advice are also paid by commission for selling financial products. So they may get a big commission for you investing in a particular vehicle that they sell, a savings vehicle that they sell, as opposed to there are financial advisors that are what are called fee only, who are not going to sell you anything except their expertise and advice. But I totally agree with Ross and Patty. I think at this stage, the benefits of using things like the AAMC or White Coat Investor is that you're getting advice, but you're also educating yourself, so that after you read that book, or after you read that article, or listen to that podcast, you are a more informed person financially, and can then, if you do seek the advice of an advisor, you do so from a position of greater knowledge and preparation. And that is always a better situation. It's, that's why we read in medicine, to be prepared and to do the best we can for our patients. Well, in this case, our savings is our patient in this case, and we want to know as much as we can to do a good job there. I'm going to thank our guests today, Drs. Hilliard, Dr. Ng, Dr. Harrop, and I think that was really, really helpful, and I think you guys are going to get a lot of hits on this one. So
Thanks, Tom.
thank you
Yeah,
very
thanks
much.
for having us.